Hello everyone, welcome to another video of Market Matters with me, Dr. Diffins. In today's video, we're going to look at the second that I'm creating as a follow-up to our Market Matters video on stock investing. I'll go ahead and start off by saying that this video is not providing any investment advice. I'm not a financial advisor. It is nothing more than me just sharing my thoughts. But again, you're going to have to do your own due diligence and research before making any investment decisions. Okay. All right. With that being said, I created and posted another video on the ARK ETFs, the equal balance ETF that I was creating using the 6 ARK funds, as well as the BLOK ETF for some Bitcoin exposure. And in this video, I'm going to quickly go through three ETFs that I'm going to have in a second $1,000 portfolio. And I will start with a summary of all three of them. The first one is ETF ticker IWM. And this is the iShares Russell 2000 ETF. Okay. And we'll talk about the specifics of what the Russell 2000 is, as well as the holdings in a minute. The next one's going to be the triple Qs or QQQ. And this one is an index that tracks the NASDAQ 100. So it consists of 100 companies. And again, it tracks the NASDAQ. Both the Russell and the QQQ, both the Russell and the NASDAQ are index funds or are indexes. So for example, when you hear that the NASDAQ was down or the S&P 500 was down or up for the day, those are indexes, which are pretty much a collection of companies. And when the companies move, so does the index. As investors, you cannot directly purchase the index. So instead, we have these tools that have been made available to us in the form of ETFs that track the indexes. And you'll see a chart here in a minute that'll kind of break that down for you. And then finally, the last one, which we looked at in the other video, this is the Amplify Transformational Data Sharing ETF. And this one has blockchain exposure. Again, companies that have Bitcoin miners or Bitcoin on their balance sheets. All right, so I'm just going to quickly jump into the Invesco QQQ. We'll start there. This particular $1,000 fund that I'm making is going to be 10% crypto exposure, so 10% of this block, and then it's going to be equally split 40% QQQ and 40% IWM or Russell 2000 ETFs. As a reminder, when it comes to ETFs, you can check out the other video, the first video in the series that I have, where it kind of shows you the various ETFs that are out there. And again, they pretty much are limitless in terms of how they're organized and what's available to you. So for the Invesco QQQ, again, nice. This is directly from the company that creates this ETF, and it just pretty much lays it out there. It's an ETF that tracks the NASDAQ 100. The index includes the 100 largest non-financial companies listed on the NASDAQ based on market cap. And market cap is pretty much another way of saying like the total value of these companies. So it's going to be 100 of the largest companies in the NASDAQ or in this particular section of the stock market. Here you have 100 companies, some examples: Apple, Amazon, more. And then it's the second most traded ETF in the United States based on average daily volume. And this is important. That word liquidity, whether you're trading stocks or just talking about money, assets in general, you want assets that are going to be liquid. In other words, when it's time for you to buy it, you want to be able to buy something. And when it's time to sell, you want to be able to have buyers there to sell it. Okay, and that can go in any domain in terms of having something that's liquid. All right, and I'm just going to jump down here. This is a nice summary that they provide, and this is the growth of $10,000. And you'll notice here that there's I'm going to go ahead and click on this one. No, there we go. Let me take this one off. This is a comparison of NASDAQ 100 the QQQ, and the S&P 500. Now you'll notice here in the dark blue, this is the QQQ ticker, the ETF, and then the light blue is the actual NASDAQ 100 index. So what you can see, the purpose of this chart is showing how closely they're correlated. So because you cannot purchase the index directly, this really is a next best option, or really the only option to gain meaningful access to the NASDAQ 100. Now, of course, there's other ETFs out there. Invesco is just one of the, or I think it actually is the largest ETF that tracks the index. And then down here, they're showing the comparison to the S&P 500 index, just to show that the NASDAQ 100 has outperformed. Again, remember the NASDAQ 100 is mostly made out of technology stocks. So when you look at this chart for the last 10 years, and you think about what's been hot in the world, really has been technology, right? Thinking about 2013, you have Facebook, you have Tesla, you have Amazon, you have Apple. You have a lot of companies that would be included in this NASDAQ 100. And to see, there's a fact sheet here, keep going down to see the actual holdings. Oh, nope. Where is it? I want to see the actual holdings. It might be on the fact sheet. Okay, here we go. So again, they put this summary here, and let's see if they have the holdings though. Oh, there we go. This is kind of a summary of the holdings. So this is their top, maybe top 10 holdings. They have a total of 102. You can see Apple, 12.5%, Microsoft 10%, Amazon 7%, Tesla about 5%, Nvidia, which is the semiconductors, 4%, Alphabet, Class C and A shares. Alphabet is Google's parent company, and then Meta Platforms, of course, is the new name for Facebook, and Broadcom is a semiconductor, and then Costco, of course, is a kind of resale company, you know, the retail chain there. Here you see the exposure by geographic allocation, and then you can see how it's broken down by sector. So again, the beautiful part here is you're looking at a total of 100 companies heavily weighted towards technology with a proven track record of increases. However, that's where that caveat comes in. Remember that past performance is not always indicative of future success, or future returns. But again, nice little summary here, and then the performance of the ETF over time since its inception. Pretty strong gains there. Thinking back to our earlier videos, remember you start plugging these numbers into a calculator. It's a lot higher than the 10% assumption we use, even at 14 or 15%. If you could receive those types of gains with very little, effort on your part, then you can see how it might be worthwhile in the long run. And again, it's going to depend on your own personal financial objectives and abilities. Go ahead and move here to the iShares Russell 2000. And you can see like iShares, this is a BlackRock company. Invesco, again, is another firm. Spider is another firm. But this is the Russell 2000. And it seeks to track the investment results of an index composed of small cap U.S. equities. And so YIWM, exposure to small public companies, access to 2,000 small cap domestic stocks in a single fund, used to diversify a U.S. stock allocation and seek long-term growth of your portfolio. Okay, it looks like they have something similar here. Let's see if I can click on the chart. Growth of a hypothetical, $10,000. And you can see this was this is over a 20-year period. And I think the key here, though, is to see that it's top right? So that $10,000, sure, it ebbs and flows. Sure, it crashed there, but same or very similar outcome to what we saw with the QQQ, where over a span of, I guess in this case, like 20 years, you could turn $10,000 to $60,000. And that would just be by leaving it in that fund and not doing anything else. Okay. And just talks about the different things here. All right. So then moving down, I just love the layout that they have here. I love the information that they provide. So transparent. You can see just with a little bit of research, you can kind of at least gain an understanding of investments. And it's just interesting. Again, all able to read. This talks about ECG. This is going to be sustainability, right? So this gives it a rating here. This one's BBB rated. And there's your kind of description of those there. So if you're looking for companies that are heavily into preserving the environment or being sustainable in their investments and companies that they invest in, then this would be ratings you want to look at. There you go, your weighted carbon intensity. All right, I'm going to keep going down. Business involvement, and they're, again, fully transparent. Here you have some maybe holdings that they have that are considered controversial: weapons, civilian firearms, tobacco. And they're being upfront about this because some people have, you might object to tobacco in general and you don't want to invest in it. You don't want to invest in companies that invest in it or make it. So they're just saying, hey, we hold 0.2% of our fund includes, tobacco products. All right. And then moving in business involvement coverage, you're going to keep going down. Fees. This one only has a 0.19 fee or expense ratio. That's pretty cheap. And then finally, we come down here and you can see by market cap weighting, you can see what their largest holdings are. And you can see it's a lot of energy here for their largest holdings. And then remember, these are small cap companies. So as opposed to kind of the behemoths that we were looking at before, billion and trillion dollar companies like Apple, it's over $1 trillion. These are smaller companies, but names you may very well recognize. For example, here's Macy's or AMC Theater. And again, it's a conglomeration of several holdings here. Okay. And it's Russell 2000. So yeah, it's actually 2000 positions. All right. And then finally, here's a breakdown by sector. So you can see it's heavily weighted in the financials, then industrials, healthcare, information technology, consumer discretionary. And it kind of goes down that way. And then here's a lot of information here: prospectus, annual reports, how to buy through the brokerage fund, and to add it to your portfolio. So again, that was just a quick summary. We went over the charts here. Both of these are down about 28% on the year. And remember, our goal, or the goal for this portfolio, is just to see what it does over a long period of time. And in my mind, if history is any indicator, if it is, then over time, this upward right trend is going to continue, and these will eventually start going up. Not sure when, but I'll be patient and I'll be adding money to it. Like I said, every 2 weeks, and I will keep you updated, and we'll just monitor the portfolio together. All right, a lot of information, but as always, I appreciate your time. And this is Dr. Diffins signing off. Bye-bye.